Good morning. I'm Desiree Doubrox, founder of An Empowered Woman and Homework. And Homework is where you can live where you work where you live, anywhere in the world. And every Wednesday morning, we have the members present their businesses, the opportunities, the programs, and the products to our community. And today, I had the pleasure in speaking to René Nourse, who is the founder of Urban Wealth Management. And Renee, you've been with us. I was telling someone the other day, since day one, we were in my living room in Westlake Village. You're one of
Yeah.
the very first speakers, and that was like way back in 2007, 2008. Do you remember?
I thought it was before that. Oh yeah, it was before that.
Was it before that?
Yeah,
It
it
was a
was.
very, very long time ago, and you've been with us
Mhm.
for all this time. It's what that means is that one, you are an expert at what you're doing. You've hung in there. You've been doing it well, creating financial freedom for many, many women throughout, for all these years. And we have been, pushing our support as well.
Absolutely. Thank you. Yeah, I
But
was thinking about that on my drive in today. I think we met 2 decades ago.
2 decades ago. Yeah.
But yes, we've known each other for a long time, and you're such a trailblazer and all the things that you have been doing and are continuing to do. So thank you very much for having me here today.
Well, thank you, because I still get some comments. I think I mentioned to you that my sister was at one of those very first meetings, and she keeps telling me, she says, I remember what Renee said. She says, a man is not a plan.
And that includes Uncle Sam.
Exactly. So
We need to understand that. Yeah, I started to put that in my PowerPoint. I said, "Man, that's good." Yeah, but man is not a plan, and so I'm going to explain why. So go ahead and get started. And thank everyone for being here today. And I'm assuming I am a host, so I can share my screen.
absolutely.
Okay. So thank all of you for being here, and y'all are across the country. That's great. And so I hope that this time that we spend today, you get some relevant information that you can input into your lives. We are all multitaskers. Women, I mean, we just don't do two things at a time. We're doing two or three things at a time, typically. And so I hope that one of the things that I want to get across to you is that you need to put yourself at the top of that list to take care of yourself first, because you will not be able to do a good job for everyone else unless you're taking care of yourself first. So with that said, urban wealth management, I've been in the industry for 30 years, long time, even though I'm only 35. But I started out with major wirehouse firms, and I left Smith Barney Morgan Stanley in 2012 and started my own firm, Urban Wealth Management. I came up with the name because I really wanted to focus with working with women and professional women. And professional women tend to be in major urban cities. And that's why I came up with the name Urban Wealth Management. As a result of that, we have an all-woman team. And our focus is really, how do we help women get from point A to point Z and be able to really manage their financial life. We are financial planners, CFPs, and we also help with managing people's, not only their financial life, but also any assets that they want us to manage, but it's not a requirement. So with that said, located here in the Los Angeles area, and we have clients all across the country. So we're very blessed in that respect. So I'm going to go ahead and get started, and let me get my screen sharing here. Oops. And let's see how we do this. And
There you go. You're up.
well, this is sometimes it could be a little, let me make sure it's on the right, it's on the right screen. Okay. All right. So everybody can see this, me moving that around there. Okay. So the urban wealth management is also, we have a side group called Smart Women, because all women are smart. Savvy Money. And it is a club that we have on our Facebook page, but we also host monthly webinars, etc. the whole idea of the content today is that we really want to focus on ways to discuss how you can get your financial life in gear. And so this is not moving. I don't know what's going on here. There. We use the word gig, and I know gig stands for a lot of different things, but in our case, it's getting your financial life in gear, because we want you to be able to create the lifestyle you desire and deserve. So why is this topic going to be important? Well, in the US, even though we're considered to be the top country in the world, we still have some significant challenges from a financial perspective for our financial health and our well-being. It's not as healthy as it should and could be. And here's some dynamics I think that will be very interesting for us to kind of start this conversation. Nearly 80% of Americans live paycheck to paycheck. Now, this was before the pandemic hit, so that number is still pretty much the same, a little bit higher than that. But almost 60% of Americans have less than $1,000 in savings. Good news and the bad news. Good news is we are living longer, but the unfortunate bad side of that is that many of us are not thinking about what that timeline looks like. And are we preparing for living until we're in our 80s, 90s, and our hundreds? Anybody raise their hand? Do you have any family members that are 90?
Absolutely.
Anyone that's 100?
Well, I want to tell you real quick that with my business that I do for health insurance, I'm actually a manager for the Medicare space. And in our company called Scan Health Plan, we have over 300 members here in California that are over 100 years old.
Wow. Wow. Yep.
Yeah.
And that
And my
number,
oldest client was,
and are they mostly women?
oh yes, yeah. And yeah, in fact, my oldest client was 111, and her daughter, who was 94, when I used to actually write the business as an agent, I had this 94-year-old lady I wrote up, and then she referred me to her mother, and her mother was 111.
Wow. Amazing.
Yeah, here in
Okay.
San Juan Capistrano.
Yep. Yep. And just so that y'all know, which I'll share with you, but with the IRS now, they, you probably have heard the term required minimum distributions, where you have to take it from your retirement accounts beginning at a certain age. They now have figured out and calculated that people are living at least to 101. When I first started in the business, the average rate was about age 80. Now they calculated it up to age 101. So anyway, so we need to be thinking about the fact that, yeah, we're going to be living longer. So what do you do in order to sustain and maintain your lifestyle? So next, we have this situation where only 1/4 of working Americans have no retirement savings, which is why the Secure Act came into place. Average net worth here in the United States are these figures. Now, how can one continue to live well if that's all that they have? Your average net worth, as you know, is everything you own minus everything you owe. So you might own a lot of real estate, have a strong business, but if you have a lot of debt, you don't have strong high net worth. For women, it's a bigger challenge. We have some other issues that we are dealing with. Now, as I mentioned, yep, we live longer. We all know that we as women, we do live longer. And now it's up in the upper 80s. If you're in your 60s, now in the 70s, you're going to be living until, on average, and the numbers can be a lot higher than that, into the upper 80s. Now they're saying too that with a lot of younger people that are being born now, they're going to be living on average well past 100. So it's really important for us to be thinking about how we're going to maintain our lives beyond that. But our challenge is that for many of us, because we are internal caregivers, that we have less working years. We have to take time off, typically when we have our children. Sometimes we're taking care of our parents, of our spouses. I've got a job change and they move to another city, state. We go with them. And so we've not had the opportunity to be consistent with the working years. And certainly during this pandemic, that's been the case, where a lot of women have just had to step back. We still are earning less than men, which is crazy. We might have the same skill sets, same experience, same degrees, but we're still getting paid less than men. And as a result of that, unfortunately, there's also this low level of confidence about how we manage our financial lives. Typically, and this happens a lot, with your spouse, you might be going in to talk to your financial advisor or financial planner, but they're focusing on talking to him, not to you. And that has been a real big issue. A lot of times women feel very uncomfortable about asking a question. What's the difference between, if I decide I'm going to get a stock versus an ETF? Or what if, should I get a long-term care policy? Or they're not really focusing on it. They might feel like, okay, well, that was a stupid question. And a lot of times women hold back. They don't say, and they don't get involved, and they're not engaged in those. So as a result, it makes it very difficult. And this part is the really sad part. Average age of widowhood for women is 59. 80% of men die married, 80% die single. So it is even more important for us, majority of our lives, typically we're going to be single. So we need to take advantage and understand what the importance of managing our personal financial life is. But wait, there's more. We're just not in a recession. Well, we're coming out of it, but this is a she-cession. The gender pay parity is still off, even though it has increased quite a bit, actually, just in the last 5 years. But we're still earning less. And women, and especially women of color, we have been severely impacted. Now, as far as the pay parity is concerned, women of color are only earning about 60 cents on the dollar compared to men. And in general, across the board, it's about we're up to about close to 80 cents on the dollar, but there still is that discrepancy. But we have really been severely impacted during this pandemic. Many have been furloughed. If you have a business, you had to shut down. There's been a reduction in pay. People have been laid off. And although thankfully, the government has stepped in and has been able to provide some financial guidance and assistance in states and cities, but still, if you have a business, it has definitely, in some areas, has really negatively impacted. And because women, we tend to be leaders in family care, because internally we are caregivers for our children and our parents. We basically are voluntarily taking time off. And as we know, during this pandemic, if there are a lot of single moms, they've had to just shut down and be at home with their kids because the schools are closed down too. So we really have been impacted and continue to be impacted. But I think that this decade is going to really make a big difference. So in spite of what happened last year and the impact it's had on us, this year and this decade is going to be very, very impactful. The latest Census Bureau, and this has been the case for the last decade, women who are married tend to out-earn their men, their husbands. However, we still are experiencing less pay than men. In the US, women are the next face of wealth and legacy. It's expected during this decade, at the end of this decade or beginning of next decade, we are going to control 2/3 of this country's wealth. We make up the majority of the population in the United States anyway. We are over 50%. Last time I saw it, it said 51, 52%. We're probably at 55%. The census doesn't want to give us the whole truth yet, but we make up the majority of this population. And that's why having leadership roles and focus on what our needs are is so important. 13% of the billionaires currently, this is as of last year, were women. And 40% of US businesses are women-owned, and that is the fastest growing group in the country, is women-owned businesses. They earned 1.3 trillion last year, even though it was an awful pandemic. So here is also a chart that shows the amount of wealth, who owns what in this country. And the numbers are going to be picking up. So we're in the 1% and 2% ranges based on these asset levels. But due to the fact that there is going to be a significant amount of inheritance from boomers beginning this decade, it's expected that women will be taking on those assets and will be in control of them. So it's expected that we will 30 trillion at the end of this decade. But this is still the disconnect. We're falling short in the game of financial management in these areas. Elderly women still represent the disproportionate number of those living in poverty. We also, because we live longer, we've not adequately prepared for the likelihood of longevity. And also, unfortunately, 60% roughly, 6 out of 10 poor adults, 60% of them are women. So what we're going to cover today, I know those was a lot of content. We're just going to cover 5 very simple steps. We want you to be less stressed, use easy breezy techniques, implement them, but look at them from a different perspective. The intention is that we want you to create the lifestyle you desire and you deserve. So these are the things that we're going to cover. We want you to be conscious to help you make better decisions about your financial life so that you'll be conscientious. We want you to be attentive. And it's a good idea to have accountability. And that's one of the things that we have heard a lot from our clients, is that they like to have the accountability for someone to say, you know, go down this road, this is going to be a better fit for you. Congratulations on what you did, or don't do that. So it's a good idea to be able to create that. And there are some apps here, which I will share with you, where you will be able to do that. You want to look at things differently. So you might have thought about, okay, well, I have a retirement plan. I'm just putting X amount of dollars in it, but not taking full advantage of what the full intentions and the amounts are that you can be putting in there. And so we want you to think about how the decisions that you're making now are going to affect in the future. It's really important. And choose what you already have. You don't have to create anything necessarily new. We want to keep it simply simple. We want to kiss it, but we want you to think outside the box. So one of the first steps is know what's coming in and what's going out in your financial life. Sure, everybody can raise their hand to say, I know how much money I make, but the majority of the time, we don't know where the money is going to. So just like these ladies here who see, okay, I thought I had this amount of money, or they're at their ATM and where'd my money go? What the heck? So here are some tips. Tip number 1, track your money and your spending in real time. These are free apps. Some of them are free, some of you have to pay for. But it will track what your spending is on a daily basis. You can connect your bank account, your credit card accounts, and it also will help if there's been a scam. And that, because we know we've been experiencing that this year, where some activities have been taking place in your account. So tracking your spending is an actually number 1 goal, and that will help you to create financial fitness. It will set up alerts also. If you created a budget to say, I want to spend this amount of money each month on Starbucks, and you go over that, it will send you an alert to say, you said you were only going to spend $50, you're at $75 for this month. But you will be able to track it. That's the accountability. That's one of the forms of accountability. And it helps with the B word, budget. I hate using the word budget, but it will help with that because you will be able to create it. As one example here, you can use what's called a 50-30-20 rule. In other words, spend 50% of what your take-home pay is, put 20% aside for savings, or if you want to pay off some debt, and 30% for the stuff that you want to do, like travel, or if you're buying another piece of property, or you're increasing, you want to buy another business or increase your business. Put those monies aside. This is just one example of a budget rule. And then you can set alerts to yourself to say, okay, I just put 20% of my take-home pay into my savings account, or I'm using some of that to pay off debt. Majority of people, unfortunately, don't have a backup plan. If they are unemployed or their business shuts down for a period of time, it's important for you to have enough money set aside to take care of your home expenses, your personal expenses for at least a 6-month period of time. You want to pay yourself first. You are the key person in your life. Even though you have family, you have other people that you're responsible for. But like I said before, you want to take care of yourself first. So that is tip number one. Tip number two, get on the tax planning trail. Many of you, I'm sure, have heard within the last week, and I think we all expected that we were going to see a change in the tax laws. Now that we have a tremendous amount of federal debt, there's going to be an increase in taxes, and it will start with corporations, multi-billion-dollar corporations. So I don't think we're going to ourselves be so negatively impacted, but those who have dropped down to the 21% tax bracket. It will go up to 28, which is what Biden is saying, but it'll probably be 25. But the Tax Cut and Jobs Act for us on a personal basis for individuals is supposed to go away at the end of 2025. So we got another 4 years. There might be a change in that also. So it's really, really important to really start getting on the tax planning trail and make sure that you are going down a trail which you might not have been taking advantage of yet. These are the three major tax law changes that just took place in the last 4 years: the Tax Cut and Jobs Act, the Secure Act, and the CARES Act. Now, the CARES Act, as you know, it went away at the end of last year, but I'll go over that in a second. So with the Secure Act, it came about because, and it stands for Setting Community Up for Retirement Enhancement, it came about because of the fact that there was such a low level of participants here in the US who had a retirement plan. And so they raised the bar now to say major things. One, people don't have to take money out of their retirement account until age 72 now. It used to be 70 and a half. You also can continue to work for as long as you want and continue to contribute to your retirement account. You could be 82 years old working at Costco and making some money, but you can still put money into a retirement account. It used to be shut off at age 70 and a half also. So it's giving people more time to be saving for their longevity. Inherited IRA beneficiary rules also changed. And now it used to be, well, the biggest change is that now money has to come out of that inherited IRA within 10 years. Before, it used to be that person could take it out over their lifetime. If you're married and you receive the IRA, you don't have to take it out in 10 years. You can put it into your own IRA and keep it there for your lifetime. Contribution rules, as I mentioned, can be done forever. And now people can withdraw money from their retirement accounts if they have newly born or adopted children. They can take out up to $10,000. It's still taxable as income, but there's no penalties that are attached to that. And for 529 plans, which are college planning, now, whether it's for yourself, your child, your grandchild, they can take that money out now to pay for their student loan debt. Now, the CARES Act went away in December, but there's some major tax implications that need to be, that are still alive and well and need to be taken into consideration. If any of you accessed your retirement accounts, let's say to run your business, and you're running into some issues, and you could take money out based on the CARES Act because it impacted your income, your business income, you could have withdrawn up to that $100,000, and you wouldn't have to claim it as income for 2020, but you can spread it out over a 3-year period of time and pay the taxes on it. Or if you decide to put the money back in, you can do that, and then it will go away. So working with your tax advisor, your accountant, is going to be really key if that is something that you did, to make sure that you have the right rules in place and that that doesn't show up as extra income for you. So easy breezy, one of the top picks for us planning for our longevity is the retirement plans. So many of you who are self-employed, you can have a 401k plan. SEP IRAs, individual IRAs, but 401ks are great because you can put in a pretty big chunk. Doesn't matter if you match or if you're working for someone, if your employer matches it or not, it doesn't matter. If they do, that's great. Or if you do, that's great. But you're planning for yourself. And there is a major tax impact because any contributions that are made reduce your taxable income. Not the same for Roth, which I will go over in a minute, but Roths are pretty attractive and are a great tool. If you're turning 50 this year, whether it's December 31st, January, doesn't matter. If you're turning 50 this year, you can sign up for the catch-up. The maximum contributions for 401ks this year is $19,500. And if you're turning 50 anytime this year, or if you're 50 or older, you can put in an additional $6,500 for a total of $26,000. Now, if you have your own business, in addition to doing that, you can match yourself dollar for dollar, and you can put money in as part of your profit, any profit that you have from your business. The maximum that total can go in for any of you that are self-employed and want either have a 401k or want to have one, you can put away as much as $58,000 this year into your retirement account. Can help you build that up. And then I say, take your nickels and dimes. If you have had a business in the past and you had a retirement account, or you worked someplace else and you left your retirement account there, take it with you. Never, ever leave it behind, because you will have control over those funds. They belong to you. Now, the other part of this is going down this path. When you're putting money into your retirement accounts, the 401ks, the SEP IRAs, the IRAs, it's tax deductible. And what that means is that it's just simply tax deferred. You will have to pay taxes on it later. It doesn't go away. So how many of you want something that's tax-free? Probably everybody. So yes, you want to look at where can I get and how can I build up tax-free assets? So the best path for that, and it's tip number 3, is Roth anything. If you have a 401k, you have a Roth component, or you can fund a Roth IRA. Money goes in on an after-tax basis. And if it's in a Roth IRA, you can pull that money out at any time. No taxes, no penalties, nothing. It's the earnings that, after it's been in the account for 5 years, is completely tax-free also. So let's say, and I say this a lot to especially younger folks who are trying to buy properties, buy real estate, but also for us at any age. Let's say over a 5-year period of time, you put in a total of $20,000 into a Roth IRA, and it's now worth $50,000. If it's been in there for at least 5 years, you can pull out the entire $50,000. There's no taxes. If it's been less than 5 years, you can pull out the $20,000 that you put in at any time, and there's no taxes. So there's a lot more multitude, and gives you an opportunity for you to access the funds in this account. But the bottom line is that with these Roths, it's tax-free, and you do not have to take the money out. There's no required minimum distribution, as is the rule for regular retirement accounts. So with Roth IRAs, there are some income limitations. If your income is over a certain amount, you can't make a direct contribution to the Roth IRA, but you can do what's called a backdoor Roth. And you put money into an IRA and then you switch it over into the Roth. Do that with a lot of our clients, and they're building up a tax-free bucket. Contributions can be made at any time, and there's no taxes or penalties. With the Roth 401k, there is no income limitation. Somebody could be making $300,000 a year and still put money into a Roth 401k. Employers can still match it, or if you have a business, you can still match it. It's going to be made on the pre-tax side, and it's tax deductible to the employer. But I think it's really important for us, especially right now, to really look at building up a tax-free bucket so that that will be an easier part of our life for retirement, but also for our current life, because you can access those funds during your current life. So there are some similarities and some differences. There's a 5-year rule that applies to both of them. However, the 5-year rule is stronger with the Roth IRA. And if you are participating and you have money in a Roth 401k, make sure you have a Roth IRA open up. So when those funds transfer over, they'll go into the Roth IRA And your Roth IRA, if it's been open for at least 5 years, you don't have to wait another 5 years once you roll those monies over from the Roth 401k. So the bottom line is that when you are accessing and setting up and getting access to a Roth, that is really the best format, one of the best formats for building out a tax-free income for the rest of your life. Not only for you, but for your beneficiaries. It's tax-free to them too. Tip number 4, healthcare plan options can also be utilized for retirement, your longevity planning too. It's just not for today's health planning, but for your future needs. So, as many as you probably know, you have FSAs and HSAs. FSAs are flexible spending. HSAs are holistic savings. And they're both used for health-related issues. Now, FSAs have a use it or lose it policy. As you probably know, you have to use whatever money that you put into the FSA account needs to be spent by the end of the year. Depending on the company that you're with, you can have up through the end of February to spend the money. Otherwise, if you don't spend it, it goes back to your employer. Or if you have a business and you have a FSA set up for your employees, then you get to keep the money if they don't use it. And there can be a match that the employer can make for it too. The contributions that are made to FSAs are tax deductible. They're going in at the state and the federal level. And it can be used for health as well as dependent care for your children, also for elderly. Funds can be used to take care of family. But it is a use it or lose it. But the health savings account is a trifecta. It's tax deductible. The funds that are withdrawn can be tax-free. And they can be used, if they're not used for health, they're not a use it or lose it option. It will stay with you for as long as you want to keep it. And the HSA accounts are portable. So the difference is too that you can also invest the money that is in there. Whereas with the FSA, they generally give you a card, credit card, debit card that you use for that. Here with the HSAs, you can invest it and buy some Apple stock if you want, or whatever in the mutual funds, and it grows considerably, then you can access those funds. And if the money is being pulled out again for health-related issues, it is tax-free. If you don't use it all, you can use it for income later. Now, it is tax deductible, but at the state level, it depends on the state that you're in. Here in California, California says no, you can't take a deduction for it. But in some states, it is also state deductible. The difference here, though, is that it has to be paired with what is considered an HDHP, highly defined healthcare plan. These are ones that have a high deductible. Now, the deductibles for this year for HSAs, the deductible has to be at least $1,400 for singles and $2,800 for families. However, the contributions that can be made to it, which are tax deductible, can be $3,600 for singles and up to $7,200 for families. And let's say you don't use any of it. This is sort of like an additional way of planning for longevity purposes. That's going to reduce your taxable income. And again, when you pull the money out, it's tax-free. Now, the plus 1,000 is for those individuals who are age 55 or older, they can put in an additional $1,000. This can also be used to pay for premiums, and you can pull the money out to pay for the high deductible. So it's a great format that individuals, whether you are employed and you have that as an option, or you are self-employed and have your own business, to consider having an HSA. The FSA does have some additional benefits where it does provide for child or adult care, as well as health-related expenses. But again, it's a use it or lose it. And it doesn't allow you to put in as much. So that is also a big change or a shift. The last tip is to get your financial life in gear. It helps to have a great team in place. You are the CEO of your life. And it is a good idea. And for all of you here that have your own business, I'm sure you have a team of people that you're working with that are assisting you with your, helping you to run your business and to keep it running smoothly. This also applies to you on a personal side too. And so really being able to create a team for your business and one for you on personal, if it's the same group, that's great. But these are the key folks that you should have in place. You need a good accountant, a CPA. Now, all CPAs are accountants, but not all accountants are CPAs. And having someone that has a significant amount of experience and is continuing to get continuing ed and training is really important. So you need a strong tax planner and an accountant, not just somebody who's going to prepare your taxes, but somebody who's going to give you some directions about some adjustments and some changes that you can consider making to make next year or this current year better. A financial planner or a financial advisor. There's a difference between the two. A financial planner is a CFP. Financial advisors are typically those who focus really more on the investment side as opposed to financial planning. But a financial planner can do both. Attorneys, different kinds of attorneys that you would need, and also insurance professionals. Now, with that said, it's a good idea to do a background check on folks to know what their experience level is, and they can give you their resumes, their bios, and tell you, okay, I've been doing this, that, and the other. But there are some resources where you can look to see what is their background. Has there been any complaints? Has there been any regulatory issues that have picked up? So the other part is that once you have your team together, once you've selected them, it's a good idea to connect them and let them talk to each other because you want to make sure they're all on the same page. If your accountant is telling you to do this, but your insurance professional is saying, get this done, and they're not on the same page, but it's a good idea for them to talk to each other so that everybody is aware of what your needs are, and it's going to be much more consistent with identifying those and getting you on that right path. So these are some background checks and places and websites that you can go to. Now, I've got some here listed for California, but for the insurance professionals, it's going to be the same. Whatever state that you're in, you can do a background check on that. For financial planners and advisors, this is national in scope. Investment advisors, this is national. And then similar here where I have for attorneys and accountants, this here in California, but you can find sites there in your respective cities and states so that you can do a background check on them. And that's really important. One of the great resources is getting referrals, but you also want to do your own background check too. So I'm just going to finalize here. Again, with Urban Wealth Management, we want to create the lifestyle you desire and deserve. It's just not about investing at all. It's about helping to invest in yourself and making the best and the right decisions. So with that said, I'm at the conclusion. Does anybody have any questions?
Well, thank you. Thank you. Thank you. It's lots and lots of great information, and it's different perspectives, and I appreciate that.
Sure.
I'll start off with a question, and then we can open up the chat and see what questions are there. And ladies, feel free to unmute yourself and share. The Roth, is there a minimum amount that has to go in to start? I think what some of the ladies feel that they need a lot to get started with. They need the program. So is there a minimum amount to start, and is there amount that, minimum amount that needs to be contributed to make it make sense?
No, there is no minimum. And what I often tell people, even if you just put $100 into the Roth, the most important thing with the Roth IRA is to start that 5-year plan, because that's what IRS looks at. So there's no minimum. There's a maximum that you can put in there, but there's no minimum.
Mm-hmm. And then what are the fees associated with that? Are those the fees of the management or?
It depends on where you are, but typically, there's not any fee for opening up a Roth IRA, whether it's at a bank, it's at a credit union, if it's at a broker dealer. Now, broker dealers may charge you an annual fee. We're an RIA, SEC registered RIA, so we're not going to be charging you just to open it. Now, the investment part, if someone is investing, but if they're just parking the money in there, just, it depends on who you're working with. But the
Okay.
bottom line is that get the 5-year rule set up on and started on that Roth IRA so that it's going to be tax-free with whatever money that you put in there and whatever it grows to. If you start out with 100 and you put in $100 a month, you put in 3,000. The maximum contribution for this year for the Roth, and again, if your income is under a certain amount, for a single, if it's $125,000 or less, you can make a direct contribution into the Roth. If it's more than that, and this is what we call a backdoor, so we do that with a lot of our clients, a backdoor conversion where you open up a regular IRA, it's non-deductible, they put money in, and then the next day we put it into the Roth. And that is, IRS has said that's fine, even when we had the Tax Cut and Jobs Act, they did not make any changes to it. So a lot of high net worth individuals are putting money into tax-free buckets.
And then how does it, is there interest? You say that as it grows, so it grows through dividends or interest or?
Yeah, whatever you want to
District.
invest it in. Yeah.
Yeah.
So typically with Roths, what I recommend is because you don't have to tap into it ever. You can be as aggressive as you want in that. You can invest in stocks, mutual funds, ETFs. You can, whatever. You can invest in that. That would be better, especially right now. Interest rates are so low. So get it invested and be as aggressive as you want. Yeah.
Okay. All right.
All
I'm
right.
assuming that some of
I have
those.
a question.
Yes.
Yes.
I just recently retired and I
Really?
am, yes, I'm very excited.
Good for you.
On the 31st of March, so I'm still getting adjusted. And I decided to take Social Security, so that will be starting in May. I'll get my first check. Is there a penalty or limit on how much I can make in my side gigs?
Well, depends on your age. So this is a really
65.
important. Okay. But you're not at your full retirement age.
Right.
Yeah. And so I'm glad that you brought that up. So the full retirement age, you need to look at on your Social Security statement. It might say it's 66 and 7 months.
Mhm.
And at full retirement age, you would need to wait to that point in order to get the maximum benefit. So to your point, there is going to be a lot of times people don't realize that their Social Security benefits are taxable, number one. And then number two, you will see a reduction in your taxable in your Social Security benefit because you're not at full retirement age.
Mhm.
And so
And they take out medical too.
yeah, they'll take out the medical too, but you're going to see if your income, and I'll tell you that. So your income, if it's over this year, it's a pretty low amount, like 17,000, 18,000. If you're making more than that, you're going to see, which I'm sure you will, you're going to see a reduction in your Social Security benefit. And it'll stay lower. You might only get 2/3, I'm just using that as an example of what your benefit would be. But when you get to full retirement age, then that reduction in your Social Security income will go away. So it would be helpful to look at see what is your full retirement age. And if it's a year and a half from now, you're going to see a reduction until you get to full retirement age.
Yeah, I looked at the difference and I've got some other things going on. So I decided to take it to ease the burden on even not working so hard. Let's put it that way.
Okay. Well, here's the other thing though. If any of you have been married 10 years or longer, you can be filing against, you can file and take, it doesn't affect your current spouse, or even if you were divorced, you can still collect on your spouse or your previous spouse's Social Security income too. And then leave yours in place until you get to age 70, which gives you the maximum Social Security benefit.
Thank you.
Sure. Yes.
I had a question. My question is two things. I was taking notes and I was trying to figure out what the HDHP stood for. That was question one.
It's
What is
high
those letters?
deductible. Yeah, high deductible health plan. It's a high deductible.
Okay, that was one. And then the other one was, I have a podcast and I was wondering, how do I get in contact with you if I wanted to interview you on my podcast?
Have her information in the chat. And definitely, it's Urban Wealth Management. Go to the,
Yeah, and you can come to our, Urban WM is the website. But and I think someone asked the question, could they get a copy of the presentation? And I can send that over to you, Desiree, and you can share it with anybody who would like it.
well, what's going to happen is that everyone who's registered will, you'll get a copy of their list.
Oh, okay.
So then you'll be able to respond to send it to them as well,
Okay.
along with the repeat of the podcast. And the ladies, the email that you received in regards to this, the coffee conversation, on the second line, it has a link that's live to her direct website as well. So I'm assuming that there's a contact information there for them to do it. If not, she'll put your information in the in the chat.
Well, right. And so I am so busy. So when someone comes into the site and they say connect with us, they'll be connecting with, you can set up a time with meeting with anyone. But since I'm not listed on there for contact us, you can put in the comment section that you want to speak with René. And then that way, if the note will come directly to me. Otherwise, it'll go to one of my other team members.
Okay, fantastic.
I just wanted to say that I found your conversation fascinating. And with as much information as I already know about financial well-being, I was so amazed that I still learned some new things. So thank you so much, René. I appreciate that.
Good.
The other thing I wanted to say is the smartest thing I did at all in my financial life was 12 years ago, I opened a Roth IRA.
Good.
Yes, I've been self-employed all my life and did not realize how important that would be in my future. So I sold one of my 6 houses and I put a big chunk of money into that Roth IRA.
Oh, you can't do that.
No. They told me how much I could do.
Oh, okay, yeah.
They told me how, and I was going to say, I did this through Wells Fargo. They told me exactly how much I could put in.
Okay.
And then I only put in the amount that they said, but they do charge an annual fee. Most banks do charge $100 a year as an annual fee. Yeah. So I wanted to let you know that.
Yeah.
But yeah, that was the smartest thing I did. And then when they raised the limit, that was great also. But you got to put money aside because we are living longer. And I couldn't read your slides fast enough. So I'm so excited.
I know.
Yeah.
Well, I didn't want to just throw everybody over the curve with that, but we'll get that out.
I appreciate it so much because your knowledge and expertise is just over the top, and it was great. Thank you.
Yeah, thank you. Good.
All
All right.
Any
Any
other
other questions?
This is Kimberly. I'm sorry, can you hear me?
Yes, now we can.
Yeah, we can.
I was wondering to know, you talk about the 5-year rule when it comes to the Roth. Can you give a little more clarity around that? Is that like to be a minimum before you can withdraw, or you have to have what does that 5-year rule actually apply to?
The 5-year rule actually applies to the earnings of what your account grows to. So let's say you're putting in $5,000 a year over 5 years. And at the end of the 5 years, that, over that 5 years, you've put in 5,000. So that's 25,000 that you put in. But the account now is worth 40,000. If you wanted to get access to the entire 40,000, you'd have to wait to the end of 5 years.
Okay.
But the contributions that you make each year over that period of time, doesn't matter, you can access it at any time. And that's what I tell a lot of our younger clients, is to use the Roth, because you can pull that money out, let it grow, but you can pull that money out if you want to use it as a down payment and some real estate. And there are some rules, by the way, for any of you that are here in real estate too, that for first-time home buyers, you can pull out up to $10,000. So let's say with a Roth, they've been putting money into a Roth. Your contributions you can take out at any time, no taxes, no penalties, nothing. But let's say that Roth now has grown to $50,000. Some kid has put money in it. So they can take out all the contributions that they made plus an additional $10,000 that is not taxable. And that's good for real estate buyers. So the Roth has a lot of great qualities to it. And for us as women, we need to know what those rules are, because when things get a little wonky like they did last year, and there's still a little bit of that going here, that is a bucket that you can pull money from. And there's no tax implications at all on the money that you put in. And as long as it's been in there 5 years or longer, and you're 59 and a half or older, everything is completely tax-free. All the earnings are tax-free.
And your earnings come from the investments that you make to the Roth. Okay.
Right.
So the amount that you're going to gain, the amount that it's going to gain, whether it's that $40,000 that you're referring to from the $25,000 investment, depends on what you invested in.
Yeah. If you put it in Tesla, which you can, and it is now worth $100,000, or you bought Zoom and it's worth, it's pretty amazing. And that's why it makes a lot of sense to be what one is comfortable with, be as aggressive as they want to be in that Roth, because as it grows quickly like that, you still have access to your contributions at any time, but you're growing that money for your future that you can access too. And again, it's tax-free to your beneficiaries.
And so, and your company advises the individual on what they want to invest in. You'll be able to determine or assist them, support them in with how risk averse they are as far as what investments they make, and that would determine what their profits would be from it.
Right, exactly.
And I think that's the difference between, because all of us can say, okay, we'll go out there and, open up a Roth, but being able to have that the advisor like yourself, who's seen and who has their pulse on it. Ladies, what I find is that we are really good in our businesses, whatever our sweet spots are, but we cannot be a genius in every area. So as far as the accounting and the financial and the legal and things of that area, we may know enough about it to get ourselves in trouble, but we don't know enough about it to really, benefit from it. So that's where you resort to the advisors, because again, it's either they're going to save you money or they can make you money. But a lot of times we do things that make moves that we don't have any advice on, and we don't know that it could be, again, causing tax consequences or not be just earning as much as we possibly can. So that's the value of a tax advisor. And I know that some of them, I think some of the ladies may not be familiar with how some of them work. Some work on a fee basis and some work on a percentage basis. Could you share with us, if someone wanted to get involved in securing your services, what that would look like or what it could look like?
Sure. So before I get into that, that's a very good point, though, in terms of with your, this is also very important with whoever your team is. When we're talking about doing Roths, to make sure that your accountant or your tax advisor is talking to your financial planner, because sometimes those tax advisors don't always know all the rules around Roths. And so they may not be posting it properly. From our perspective, we always focus on financial planning at the start date. So somebody doesn't have to have an account with us in order for us to provide them with insight and directives about anything. If they want to have a Roth and they have it at Wells Fargo, or they have it at their credit union or whatever. We have a platform that I was just showing you earlier where you can track your expenses. We have a platform where we can view and see what your investments are, your accounts are in different areas. So we can be your financial planner and help provide some guidance and directions about your personal and your business life. And then we can also give you some advice about your investments, but your investments don't have to be here with us. If they choose to be here with us, we have everyone custodied at Schwab. We charge a flat percentage fee of 1%, and that's charged 1/8 per month. We charge it on a monthly basis. For our financial planning, it's a flat dollar amount, and it's a retainer for basically a year. And we cover a variety of issues, everything from financial planning, estate planning. We don't do estate planning, we don't do tax planning, but we have a variety of different platforms where we can review it and go over that with you. Debt management, credit scoring, your insurance, we cover all of those things to make sure that you have adequate and the best choices for you on your financial planning side. So even if clients come in to say, I just want you to manage my money, and we say, we don't know what to do with your money unless we know what your timeline, your goals, and your objectives are. We need to start a financial planning first. And then, so that is our primary initiative.
Okay.
So I do have our services brochure, which I can send over to you too, Desiree.
Okay.
Or I can send out to everyone and they can see what our services are. Because we do work with individuals, businesses. We have financial planning for that. We have a number of nonprofits that we serve, that we provide services for. We provide 401k plans. I mean, we do a lot of different things. And our initiative is really, again, for women, is to really focus on the financial planning side, because that is the most important starting point. We do host monthly webinars. As a matter of fact, March, we had a talk on real estate. And Desiree is going to be our speaker this month. We have a webinar that's hosted on the last Thursday of each month. So we'll make sure that you get the, matter of fact, we just sent out the invitation yesterday, Desiree. I think you're on our list. You should have seen your picture and an overview of your topic. But our topics are on a variety of lifestyle related things. And so that's another way where you can just kind of see who we are, what we do, and what our services are.
Fantastic. So again, what we'll do is I'll provide all the information to you. You'll get a list, and then you'll be able to follow up with them. And then whoever wants more information, I guess they would contact you for a consultation, and you'll be able to see where they're at. But again, as we plan for our businesses and as we work hard in our businesses, we need to know that it's not all that what we make is what we keep. I'm sure
Yes.
you've heard that before, but it's not what you're making, it's what you're keeping.
Yeah.
If you're making lots of money and spending lots of money, at the end of the day, you've had a great ride, but you don't have putting out the gas, you don't have anything to ride at the end of the day. So just make sure that you're going to keep as much as you're making. And any other questions before we close? And thank you.
Well, there was one question here. I wanted to see what the difference is between a Roth and a SEP IRA. So just real quickly, SEP IRAs are for self-employed or for businesses. And with the SEP IRA, they are strictly funded by the business. The employees do not contribute. So if you have employees with the SEP IRA, you are building up the platform to make contributions to it based on what their salary is. And you can customize that based on the terms of the SEP IRA document. The SEP IRAs do not have a Roth component to it. So the SEP is basically the profit sharing side. The IRA is individual contributions. But with the SEP IRA, if you have employees, you're making the contributions for your employees plus yourself. If it's a 401k, they are making their own contributions. You're making your own contributions, and you can do a match. If you choose to, you can put in a match for your employees. And with the 401ks, you can have a Roth side of the 401k too. hopefully that answers that question.
Any other questions, ladies? Everyone's so quiet. I think everyone's thinking, must be those dollars in their heads like, oh my gosh.
I know. That's why we like to do a series of things. So it's not like, oh my God, there's a lot of stuff.
We
I have one final question if I have time, Desiree. This is Kimberly again. You mentioned that like your business can contribute, if you have a business and you could have a match, like if you had an employer match, but if you have the business owner, the business can make a deposit. Are you also saying that then I can match my business with my personal income from my business?
For the 401k or the SEP?
Was that for the Roth? This is a previous question. I think you said it was either the Roth or one of the traditional RAs. You mentioned that you can do a match to your business, a deposit that your business makes, so then you can match those funds for more aggressive growth.
401k?
Is that the 401k?
Yeah, for the 401k.
So I can establish a 401k with my business, and then as a recipient of income from my business, have a match like if I was employed with someone else. Is that correct?
Right, exactly.
Okay.
Yep, you can do that. And if you're the only person, you can still have what's called a solo 401k. And if it's you and your spouse, it can still be a solo 401k. But the 401ks will give you a lot more options, I think, because you can have the Roth side. You bring on an employee, you don't have to make a contribution for the employee. The employee can say, I want to put in 5% of my pay. You don't have to put anything in unless you're going to do, which a lot of employers do, they put in a match. But usually after the employee's been there for at least a year, then the employer can match it.
And it's also a good
contribution
incentive.
is.
It's also a good incentive for employees to stay, to know that if they stay that period of time, you can match it.
Right. So Senweed says, which is better for saving, Roth, 401k, or an IRA? I would say a 401k, it would be at the top of the list for your longevity planning piece, because it can combine both the traditional 401k pre-tax contribution, and you can also have the Roth included with it. But the good thing is that even if you have a 401k, you can still have a Roth. You're not prohibited from having both of those. And you can have it. So for my example, for me, I have a 401k here for my employees and myself. I got a 401k traditional side. I put money into my 401k Roth, and then I have a Roth IRA on the side, doing a back door, putting the money in to a traditional and then popping it into the Roth IRA. So that way it can start really building up that tax-free bucket. I have many clients who now they're like, oh my God, I got to take out $80,000 from my retirement account. I don't need that money. It's taxable as regular income. Yes, I know, but you did a good job saving for it. But if it had been in a Roth, you wouldn't have to take any of it. And if you did take any money out, it's tax-free. So start now, get that Roth going.
I like the idea of a tax-free bucket.
Tax-free. Tax-free.
I need a big tax-free bucket.
Yeah.
I need a barrel. A tax-free barrel.
We'll have a tax-free boat soon. Yeah.
All right, Renee.
Right.
Thank you.
All right.
And I would definitely
Very
thank you
good.
ladies for participating. We appreciate your time and your
Thank you. Thank you all.
She'll be able to follow up with you. So just if you have any questions, you'll be able to follow up with her as well. And I will thank you. And hopefully a reminder, everybody, Sunday. This is second Sunday. And we're doing it from 9 a.m. Pacific time to 10. And then from 10 to 10:30 is the after party. So every second Sunday of the month, we celebrate women who have built $1 million businesses. And this month, I'm being interviewed. So you'll be able to ask me anything. And I know it's the first time we talked about it yesterday. It's going to be fun. So just being interviewed by Susan Fries, who is one of our members, and she's also built $1 million businesses. So join us, share it, spread the word, and we're going to have a great time on Sunday morning. You get educated, motivated, and inspired. So look forward to seeing you then. Mark your calendar, save the dates. Emails are coming out today, and you'll be able to RSVP.
All right.
Renee.
All right. Thank you. Thank you, everyone. Take care.
Thank you.
Bye.
Wonderful. Bye.
Good. Thank you. Bye.
Save the chat.
Save the chat.
Oh,
Save the
dear.
chat. As Dawn says, save the chat.
Yeah.
Yes. Well, you'll save it because I guess,
Yes.
okay,
It saves automatically for Desiree.
right. Yeah, I know.
That
That's
was a
what
great
ours
one.
does,
Oh my
actually.
goodness. So
Good.
many good tips.
There we go.
For
Let's get
those-
Tips and
morning.
tricks. Yeah. All right. Take care.
Thank you.
Bye-bye.
Bye now.